Progressive Planet is a manufacturing company and green technologies developer servicing the agricultural, industrial, animal health, and infrastructure markets. The company just released strong Q2 fiscal 25 financial results, and CEO Stephen Harpur is here to discuss the results, outlook, and answer questions from the audience. I'm Martin Gago with Market Radius Research. It's Monday, December the 9th. Please remember, this is neither a recommendation nor investment advice. Steve, congrats on another solid quarter. Please give us a rundown on the quarter and we'll discuss the results.
Thank you, Martin. Unlike yourself, I got a full night's sleep last night because I didn't get to go to the Taylor Swift concert with my daughter. So lucky you.
Yes.
But I'm fresh as a daisy for this presentation. So I'm just going to go through very short. I think I've got about 12 slides here, and then we'll open it up for questions. Thank you, everybody, for taking your valued time to watch this today. Progressive Planet, we had a banner Q2, and we continue to get up every day and produce products for a healthy planet. We make products for a healthy planet, and I've put together a little visual here. The base of our business is vertically integrated manufacturing. Every product that we make is made from one of 5 various silicates. Our diatomaceous earth, bentonite clay, and zeolite, those are all aluminosilicates. Quartz and waste glass, urban mining, those are, waste glass is a sodium silicate and quartz is just a straight silicate. So building on that base of that legacy vertically integrated manufacturing since 1989, we are developing cement tech and ag tech products. We have one patented ag tech product today with 9 years left on its US patent, activated burn fresh. It contributes a significant amount to our bottom line. So our legacy business fuels innovation. Our proven legacy products generate cash flow to fuel innovative solutions like pause glass. And you can see some of our key legacy products. Diatomaceous Red Lake Earth, a very large seller in the US. Can-Dry is an industrial chemical-free absorbent sold in every Canadian Tire in Canada, sold in Princess Auto, sold in Lordco, sold in many other places. Wondercat, we make that product for Costco in BC. Activated Burn Fresh is sold in US organic broiler houses. And you can see a list of some of the big companies that we deal with. We are a B2B. We sell to distributors or large national chains. We have roughly 125 customers. Some of our bigger ones include Tractor Supply, where we're in over 2,400 stores in every one of the continental states of the USA. In Canada, Home Depot, Loblaws, Federated Co-op in Western Canada, etc. Pardon me. I'm not going to talk a lot about pause glass today. I'm going to speak a lot more about it in January. Today's call is focused on Q2 results. We have just a brief update. We've removed all the legacy equipment in 734 East Sarcee, which is the building at our main facilities where we will host the pause glass pilot plant. All of that legacy equipment in the lower level of 734 is removed, and several long order pieces of equipment for the plant have been ordered and received. Now, digging right into our financials. So I want to start to illustrate a trend. And if you look at our EBITDA for fiscal year 2023, the full year is there. As you can see, it was less than $400,000. And then the EBITDA for the entire of fiscal 2024 that ended April 30th of 2024, it was just shy of 1.4 million. And in the first 2 quarters, so from May 1st to October 31st of 2024, you can see that our EBITDA has exceeded 1.6 million.
And sorry, just to state the obvious, so you've gone 6 months of this year and you've already exceeded last year's full year EBITDA.
Correct.
All right.
And
Is
we
it
have
fair
several
to
other. Sorry, go ahead.
could one extrapolate? Maybe we're getting a little ahead of ourselves. Could I then say, oh, you're maybe going to do 3.2 million of EBITDA for this year? Is it kind of linear going along, or is there some seasonality, or maybe some little?
We have a small amount of seasonality. Q3 typically tends to be a little lower than Q2, but it's not significant. And Martin, if you keep asking questions, I'm going to let you finish the presentation, and I'm going to sit back and watch. Okay,
All right.
just kidding. I do have some of these. I've known Martin long enough that we can kid around to all those listening. Gross margin here, again, same trend. When we first bought the business, we had gross margin in our very first quarter in 2022, February through to April. We had under 13% margin, and we've steadily grown it. A lot of that has been discipline on costs, and we have had a very favorable exchange rate on our US sales. So that has contributed some to the margin, but it's certainly not the only reason that we have the margin that we have. I want to talk about revenue growth. So we have been shrinking the low margin revenue and growing the high margin revenue. And if you look at our gross profit in Q2 of this year versus last year, you'll see that it's significantly higher for this year. Now, our total revenue grew only very modestly, as you can see, 5.47 versus 5.44. If you start to look beneath the surface, in the Q2 from fiscal 2024, in the quarter, we had $570,000 of third-party mineral sales, and that was specifically from White Lake Earth, which is a diatomaceous earth deposit where we sold the product, but we didn't own the mine. And the last sales of that were in Q2 of last year. So when you look at 570 and you divide that, you can see that's over 10% of sales. Without any sales of White Lake Earth in the current Q2, we still just slightly grew the revenue, but the margins were better because the margins on the White Lake Earth were significantly lower than the incremental sales we made to make up that business. So beneath the surface, there's a very encouraging trend in selling. And I say to our staff, it is not what you sell, it is what you keep. So to me, it's far more important what you have left in the bank. It's easy to buy business and to go out and generate 10 or 15 point margin sales, but they're very meaningless to the bottom line. So we've been very focused on quality revenue versus quantity revenue. So improved cash position and financial resilience, as you can see. So after I gave some guidance and I said we had over 2.5 million in the bank, when I made a press release after the sale, we announced the sale of the building before quarter end, and a lot of people just assumed that, well, we had 2.5 million in the bank. I said we had over 2.5, and in fact, when we reconciled all of our bank accounts for our various subsidiaries, parent, we had just over 2.9 million in the bank at the end of the quarter, and you can see the significant growth in the cash. Now, where does that come from? Of course, there was a big bump when we sold 663 Sarcee Street, sold that lease, but also it comes from high margin product sales. The other thing to note is that we front end a lot of our annual costs, our insurance for the year, large annual software purchases for accounting system, CRM systems, et cetera. Those are front loaded, and we typically tend to accrue more cash in the back end of our financial years.
Sorry, just to there's also, you've been share buybacks, so that's you've been able to buy back a bunch of shares and still have that cash.
Correct.
sitting there.
So we bought back to over 2.7 million shares. The exact figure is in the cash flow statements. You can see from the cash flow statements the allocation of funds to the share buyback. But really good point. We had 2.9 million left after some fairly aggressive share buybacks during the quarter as well. And those numbers have been posted in press releases. So operational efficiencies fueled increased profitability. This is the real big number that excites me, and that's income from operations. They increased from just over $250,000 to over $1 million. So what is the root cause? Well, number one, higher margins, but even more critical, lower fixed costs. So we had spent money from 2022 through 2023. We had some pretty significant money spent in R&D. And of course, we had duplicity of roles as we merged two companies. So it took us just under 2 years to get that right mix of a team, to avoid redundancies and to focus on cost controls. And it was really in October of last year that we really started to focus heavily on cost controls. And we've seen the results since that time. I want to note that I have been quite active on LinkedIn. A lot of our shareholders are connected with me personally on LinkedIn as well as through Progressive Planet. And I've shared some updates, videos, photos. We're well on our way in our move to increasing automation in our plant, and essentially automation will limit increased fixed costs while enabling growth. So we are able to borrow money at very effective rates if we choose to do so for investing in automation. We're sitting on $3 million in the bank, while we also have access to multiple unused lines of debt financing for the investment in equipment for automation. So to that point, scaling for growing demand, we're planning a strategic investment of $3 to $5 million. Now, before I say anything further, the equipment that we are intending to buy, these are pieces of machinery that last for decades. The robot that we have right now, the one palletizing robot, it's 17 years old, and it works really well. It has some parts that get replaced, but and it has regular maintenance. But we have one palletizing robot that's 17 years old. We have a roller mill that was originally made in 1947. The company bought it in 2004, and every several years it goes through an overhaul. But these large pieces of heavy metal equipment, they tend to last very long periods of time. There was minimal investment made in the decade before we acquired Absorbent Products in February of 22. And we are essentially looking at making a significant investment to scale up throughput and to increase the use of automation and robotics, especially as it relates to filling and handling heavy packages. So what does that investment do? That increases powder production and increased throughput and automation. Again, a minimal increase in fixed costs. Obviously, there is a cost to debt. We have found that banks are now coming to us and looking to do business with us and offering us very, very favorable long-term debt rates. And so we have access to low-cost debt financing, including existing line for equipment that we've had ever since the acquisition and unused. We have nothing on our operating line. And we are favoring the use of our cash and debt versus we have no interest in raising equity at these levels. So financing would be non-dilutive. Current plant cannot meet peak seasonal demand. And when I talk seasonal, there are periods during the summer where we have had some of our top SKUs that have been sold off the shelf. Last summer, at one point, we had a 53 truck backlog for one of our customers in the US. And the investment that we intend to make will ensure that we are not leaving sales on the table during peak demand going forward. Engineering is well underway. Machinery testing has been completed again recently. Our VP Operations, Andrew Towsley, and our Head of Maintenance, Sonny Verdi, and myself spent 4 days in engineering and testing grinding equipment in New Jersey. I posted significant photos and videos of that work where we underwent testing with 4 different minerals that we handle. And we are expecting detailed costing for the full plant upgrades by March of 2025. I will note that we have invested, bought, and paid for a brand new PLC system, which is essentially the backbone of the plant. And we will be shutting down for 2 weeks in January in the current quarter to install a new PLC system that will be the backbone that will enable us to make the investments in robotic palletizing and automated filling and increased grinding capacity and handle that through a new and upgraded PLC system. And again, that has been bought and paid for. We were going to do the shutdown this summer, but we simply got too busy, so it's been scheduled for January of 2025. Share structure, it's gotten a lot simpler over the last 2 years. There are 8.3 million shares that expire in March of 2025. Sorry, 8.3 million warrants. Those warrants were issued to 3 of our senior team members who graciously personally guaranteed 30% of the debt that we borrowed from Bank of Montreal in February of 2022. Those are not in the money, and it would bring me a lot of joy for those people to actually reap that reward between now and March 2nd. We'll see what happens. Total shares outstanding, 109.7 million. Again, that's been reduced by 2.7 million. The last issuance of any significant tranche of shares happened this year when the third share issuance for the purchase of absorbent products. Those shares were at 35 cents, and so they were not based on a value. They were based on a value at the time of the transaction. So I'm excited that we did not have to issue more shares because our shares were trading below that price. There are 8.6 million options with an average strike price of 26 cents, and we have fully diluted 126.6 million shares. So why should you own planned shares? There's essentially a minimal value given to our intellectual property. Our IP assets include one US patent with 9 years left on the activated burn fresh, and patent pending on pause glass, as well as R&D in development and other forms of cementitious, as well as other ag tech work that we are quietly doing. And when we think we have things that are material in nature, we'll discuss them in public. So there's also an arbitrage in valuation versus private equity cement. I'm happy to share with anyone who wants to see a list of the investments that have been made in the last 5 years in private equity companies focusing on decarbonizing cement. Our cash flow is funding our intellectual property and our product development. We've remained disciplined there, and I think we have a competent and aligned management team. So that's it for my presentation. And Martin, I welcome any questions from you that you wish to read out, or any questions from our listeners.
Thanks, Steve. That was a good overview. Some things that popped into my mind as you're presenting. You said you're going to be shutting down for the PLC implementation in January. Is that going to hurt your fiscal third quarter results, hurt a bit on revenues, or do you have enough inventories where you can still keep shipping through that time?
So we can continue shipping. we cannot create any material in our main plant. We do have some production of some third-party toll processing that can be done in one of our other buildings that will not be impacted. But for the most part, it will have a small effect on revenue. But the way we do business, we receive a purchase order, we make the material after we receive the purchase order, and typically we have the material produced and shipped within 60 days of the PO. So we have a whole bunch of POs right now that we are making material, and we are stockpiling some material. We traditionally don't do it, but some of our better selling SKUs, we are stockpiling in advance of the shutdown. I think it can have a very small effect on our revenue, but I think it would be less than 10% variance from a traditional Q3 quarter. But small effect, but not overly significant but again, this is a future event, so I can't tell you exactly what revenue we'll do in a quarter. Minor impact is what I see for it right now. I must say, we had planned to do this shutdown last summer. It is absolutely imperative for us to be able to grow our company and to install more robotics, more automation, larger grinding circuits. It is absolutely critical that we make this investment in a new PLC system. And it's bought and paid for, but we had to pick a time. So we picked the time several months ago, and we chose it strategically for a time that we are the least busy in the year.
You talked about your plans for 3 to 5 million of investments. It sounds like that's driving efficiency, so you have greater throughput. How much additional revenues do you think that 3 to 5 million investments could drive? And as well, I presume it'd make you more efficient as well, improving gross margins. Could you comment on those two items?
The investment in this equipment, and in most particularly, we have 4 production lines, and the one that requires the most improvement is what we call our valve pack line. And valve packs are bags that you essentially fill powders in. If you go and look at a ready mix cement bag in Home Hardware or Home Depot or Lowe's or Rona, those are valve pack bags that you tear open the top. So we make several of our top SKUs in these valve pack, and it is very, very labor intensive. They're 40-pound bags. They're manually stacked. They're manually held for filling. And we are looking to increase the throughput of that area of our plant from 1 bag a minute or 60 bags an hour to 6 bags a minute or 360 bags an hour. So it's a 6 times improvement. It is specifically the valve pack where we have shortages on seasonal demand for Red Lake Earth and Stall Dry, Red Lake Earth, not Stall Dry, product that is a very, very strong seller for us in the summer, the 40-pound bag. And when we had a 53 truck backlog of orders for US customers, there were shelves that were bare of that product in the summer of 2024 because we simply couldn't meet peak demand making 60 bags an hour. So the biggest investment for us and the weakest link for us to growing is the valve pack operations. What can we do in incremental revenue through the productivity? We could, with available plant capacity now and the new availability, we can easily double our revenues from the 20 million mark to 40 million annually. So some of that is based on bottlenecks and seasonal output, but we also need to, we will need to grow into that additional capacity. You just don't make bigger machines and snap your fingers and instantly double your revenues. You have to invest to increase your capacity. The thing that we focused on most over the last 2 years was our gross margin and controlling our fixed costs to get us to the point of generating, significant cash flow on a quarterly basis. Now our efforts are focused on growing our revenues, but we are not going to just grow our revenues with low margin business. We will be picky, and we are looking to maintain strong margins as we grow.
In the whole scheme of the economy, your revenues are very small. Are there still a lot of growth opportunities, markets, or regions that you haven't tapped? So it takes a while to build up sales and distribution, but you see in different markets or regions, or just expanding with your existing clients, lots of opportunity to take that extra product?
So first of all, our new sales team has been there less than a year, and bear in mind that in the last fiscal year, we did about 1.6 million of White Lake Earth sales, and now that those do not exist anymore in our current fiscal year. So replacing those, and in the quarter, I mentioned 570,000 in Q2 of last year and none this year. So we have grown the business. We have grown our vertically integrated business this year. Our total revenue has been flat, but our internally owned product revenue, which is higher margin coming from our own quarries, has grown. And now we are focused on further growth. We have two products in particular that we are looking to invest resources into building the brands, and those are Stall Dry. And Stall Dry is a remarkable product that mitigates smell and keeps stalls, predominantly for horses, dry for mitigation of hoof rot and odor. And the second product that we are looking to really invest in is Can Dry. And Can Dry is chemical-free absorption. We are looking to start to promote Can Dry as a safe and effective anti-slip for spill cleanups. When you spill oils in plants, it's a wonderful material, chemically free for absorbing hydrocarbons and various oils, but also for making it a non-stick or non-slip surface. So specifically, we are looking to significantly invest in promoting Stall Dry and Can Dry over the next several years.
All right. I believe you mentioned that you'll have detailed costing on the upgrade program by March 25. And then I guess that's when the go, no go, or decision to implement all the investments would come into play. How long would it take to get those all done, and then to see you operating at that that double capacity, so you can really put your foot down on the revenue growth?
I think realistically, we need a year from order. Several of our pieces of equipment have 6 to 8 months of lead time.
Yeah.
So there are some pieces of equipment that we know. So when we were in New Jersey, we were testing a very specific mill. We're finalizing a decision on the sizing of that mill and whether it's going to be 2 smaller ones or 1 larger one. We think that that decision will be well before March. That's a January decision. We're getting engineering data. So the level of detail that we've gone into in equipment selection, we've literally been taking the moving parts, the wearable parts, and weighing them down to the gram before and after grow trials to actually measure the wear rate, so we can calculate the operating costs. We know what the horsepower draw is, but then also what's the op cost for wear. Anytime that you grind any minerals, you do get attrition or wearing out of blades, discs, etc. So we were in a very detailed engineering study last week, and we'll be making decisions on and the mills. This mill is the core of the increased grinding, so that we can do 360 bags a minute instead of 60. Your plant is only as good as its weakest link, and you can have robotic palletizing and auto filling, but if you can't keep the silo in front of your valve pack filling machine full, doesn't matter how fast you can fill the packs if the reservoir behind it is not full. So that's what we've been working on. And again, I mentioned the valve pack is our area where we see the biggest incremental increase. So I gave a date of March. Lots of the equipment will be ordered before March, but there are some, I put that in as an estimated date, which will have full quantification and financing arranged to pull the trigger.
I believe you may have misspoke just now. I think you said 360 bags a minute. I believe you mean an hour
I
on
meant
that.
an hour. Yeah, I absolutely
Okay.
did. Um, I'm not sure in my lifetime I'll ever get to 360 bags a minute, but there are companies that do that.
All right. All right. All right. Let's take some questions from the audience here. A couple questions here. Are you worried about the Trump tariffs?
Yes. I am worried. I believe historically there has been Mr. Trump prides himself in his negotiating abilities, and I believe that he got the attention of our prime minister. I don't think it is. I think there's a correlation to how quickly Mr. Trudeau arrived in Mar-a-Lago for discussions. So yes, I am worried. Do I think that we can manage? And I'd say yes. Is there a potential that we will have some loss of margin in US? Yes. One of the things that we are looking in some of the products that I just mentioned is to greatly increase some of our Canadian sales. We have been blessed with a strong appetite for our products in the US, and we've spent a significant amount of effort to grow that business because the profits are so good. So we will spend more time looking to develop an incremental Canadian business, but our margins are sufficient that I believe that we will be able to still generate positive cash flow from US sales with the implementation of tariffs, but I don't believe they're going to be 25%. I think the number may be closer to half, and the markets are not building in anticipation of 25%. But this is a future event. We'll have to wait and see what happens. But yes, I am concerned.
Yeah, and as well, I'm thinking as well, if those tariffs do hit Canada, that's probably going to hit the Canadian dollar as well. Again, mitigating, reducing the total impact. It kind of hurts the rest of Canada and our total wealth, but it does in terms of exports probably blunt it a little bit with a weaker Canadian dollar. For what
Totally
it's worth.
fair. And so we do have the protection. Again, as we've seen a more rapid decline in the Bank of Canada rate versus the US overnight rate, we've seen a decline in our currency, and now they're talking 25 or 50 points this week. So we do make better profit on our US sales and equal profit on our Canadian sales. The only expenses that we have in US are we purchase sodium carbonate, which we use to make clumping cat litter, and we purchase citric acid for our organic input activated barn fresh patented product. Other than that, we have very little in the way of US expenses, but we will adjust. The company has been around since 1989. Since 1989, there has been times when there has been a 55-cent dollar. There's been a 105-cent dollar since 1989. We will react as we need to protect our shareholders, and we are taking this very seriously.
All right. There's a question here. I think you've addressed it, but I'll ask it again. I'll ask it and to see if there's anything you want to add or clarify. What is the time frame to install robots and grinding systems for your other three lines?
So the first line, we call it our CM line, and that's where we make our cat litter. That has semi-automated filling, and it has robotic palletizing today. We've had a robot on that line for 17 years. The other two lines, we are working at integrating them into our other operations. I cannot provide dates, but from a materiality perspective, by far the biggest dollar investment and the biggest influence on our productivity or our throughput is the valve pack line. These four lines are not created equal. They do not do equal amounts of revenue. By far, most of the revenue comes from the CM line, which already has robotic palletizing, and the valve pack line, where we are implementing robotic palletizing and automated filling. So I'm not discounting the question, but from a materiality point of view, these are relatively smaller investments and smaller impact on plant capacity. I should just add, we do intend to, over the course between now and March, we will make decisions on those lines as well. There's not nearly as much engineering required for those lines as there is for the valve pack line.
What's the growth rate in revenue expected from your investment on automation, and what is the payback time?
Those are good, but virtually impossible questions to answer because I have to estimate future sales. And unfortunately, I simply cannot. We need to have the capacity before we can utilize it. Except for the point where we have had bare shelves because we weren't able to meet existing demand in time and we lost orders. But I think it's fair to say that the first effort we had to make was to be more profitable with our legacy operations, and secondarily, in order to invest for growth, we simply have to invest in the automation before. I can't provide that guidance. I really can't effectively answer that question. It's a projection or a guesstimate, so I just can't answer it.
All right, fair enough. I know you said that you can't really say much about pause glass and that here. Someone's asking about the final report. Just any other fill-in to say, I don't know, any quick comments on pause glass at this point?
I'm thinking that customer might be talking about pause pyro. We've not yet
Yes,
received a
yes, the
final
pause
report.
pyro, excuse me.
We're still not in possession of a final report from Pyrogenesis. So until that's done, that phase is not complete. Pause Pyro has not been a focus of ours over the last 2 quarters as we wait for final report. Pause Glass, however, we have been, without a lot of fanfare, removing a bunch of existing legacy equipment. We had a building full of equipment that has been sold, dismantled, and removed. And we have ordered in advance of, we will be building a pilot plant for pause glass in 2025. The final size of it is related to some final decisions on non-dilutive financing, and we think we'll be in a position to make decisions in the first quarter of 2025 calendar year about the size of the plant.
And here's a question that kind of dovetails into that. How much bank financing do you need for current operations? And what do you think the need for the pause glass plant could be? And does the bank financing include capital for the pilot plant?
The size of the plant that we build is contingent on whether we're ultimately successful in non-dilutive funding. So I can't answer that question until we see decisions on non-dilutive funding. Asking a question of what bank financing we need for current operations. We don't need any bank financing for current operations. We have nothing on our operating line. We've got $3 million in the bank, and we have a very, very healthy current ratio of current assets versus current liabilities. One of the beauties of having a vertically integrated quarrying industrial mineral manufacturing business is that the bulk of the costs come from our minerals. And we harvest these minerals as we need them. And other than bags and pallets and the two chemicals that I referred to, our only other significant input costs are natural gas for drying and the labor. And we make our products as we receive purchase orders. So we never carry huge amounts of inventory. So as a result of not carrying huge amounts of inventory and as a result of our cost structure based on the fact that we own our own minerals, so many of our competitors need to buy pre-processed minerals. They don't buy raw materials. They buy rock chips of various sizes that are already much of the value add's gone in, and then they package them because of our vertical integration. And once we moved away from financing cardboard boxes of private label cat litter, we had a large amount of money tied up in corrugated cardboard boxes for private label cat litter. Once we got out of that business, it was a significant decrease in working capital. So we don't need bank debt for current operations. And I referenced the fact that the investments we are making are very, very long-lasting assets. So banks typically lend 5-year money. We have been looking for longer-term money, and we've received very positive overtures for very cost-effective long-term debt. Banks want to do business with us since we've improved our balance sheet, and we are actively solicited, and it's a competitive process. But we're very excited about the cost of debt capital for us. And of course, every time prime goes down, we again save on our $6.2 million long-term debt is at prime plus 75.
There's a clarification question from that person. They were, are you going to need any bank financing for the 3 to 5 million of capital expenditures you're planning?
So there are various government programs independent of POSGLAS that are offering non-dilutive funding for the creation of manufacturing jobs in BC. And we have active applications in for non-dilutive funding for a portion of the money to spend on manufacturing. If the gross amount was $3 million and a portion of that was covered by non-dilutive financing, we would need no debt. If it's $5 million, we could potentially utilize some debt. And based on the cost of debt, we will make ultimately a decision in the first quarter of whether we choose to use our cash or save it for a rainy day and utilize very cost-effective long-term debt. And we have about 2.7 million invested in treasuries and GICs, and there's not a significant spread in the interest that we're earning and our cost of debt. So that's a decision we will make. We have ample facilities right now to do what we need to do, but we are looking and seeking proposals for cost-effective long-term debt that we will consider before we ultimately make a decision.
All right. All right, we need to wrap it up here now, Steve. So thank you very much. Any final comments before we close things up?
I would like to just say to the listeners that we understand and we have heard, we've consulted with some very smart people, and our investors want to see growth. And whether that growth comes from organic growth, whether there are opportunities for us to acquire similar type businesses where we can dramatically reduce the fixed cost by integrating logistics, shipping, accounting, and so on into our business. We are actively looking at multiple avenues for our company to grow, and we would consider, both acquisition as well as organic growth. We've set the table for significant organic growth by bringing in a very, very skilled sales team that have been incentivized to grow as we grow. And we've heard from the investment community that now it's time to focus on growth. And we've heard it and we get it loud and clear. And that will be a focus of ours over the coming years.
All right. Steve, thank you. That was great. See from
Thank you
your
very much.
Christmas tree in the background, Merry Christmas. All the best for the holiday season, and looking forward to chatting with you next year.
Okay, thank you.